Before we start this video, do like and subscribe to our channel and not miss on any updates.
Let's have a look at a question from May 24 on consolidation. The accountant Mr. Ramesh Khanna of H Limited submitted to you the following standalone balance sheet extracts as at 31st March of 24. H Limited, S Limited, A Limited, they have PPE, financial assets, investments, 14,000 shares in S Limited and 4,000 shares in A Limited. So, it has investment in S Limited as well as A Limited. Inventory, financial assets, cash, trade, okay. Equity share capital, other equity, non-current liabilities, borrowings have been given and trade payables have been given. So far, so good. The following information is made available in respect of these companies. H Limited purchased the shares of S Limited on 31st October of 23. This is date of acquisition. Please remember, it is a mid-year acquisition. They have acquired during the year. When retained earnings of S Limited was 5 lakhs and the shares of A Limited were acquired on 30th of June. So, this is on 30th of June when its retained earnings stood at 175. Okay. Inventory of A Limited as on 31st March of 24 include inventory valued at 60,000 which had been purchased from H Limited on 1st of January at cost plus 20%. Now, here always remember, if it is purchased in the post acquisition period, once you have received the control or once the associate relationship is established, only then you need to worry about unrealized profit. Otherwise, you don't need to worry about unrealized profit. Now, here inventory of A Limited include inventory which had been purchased from H. So, who has sold? The parent has sold to the associate. H has sold to the associate. Where will we eliminate this from? We will eliminate this from the consolidated reserves of the parent, right? Then trade payable of H Limited includes 25,000 payable to A Limited, the amount receivable being recorded in the receivables of A Limited. Now, here you have to keep in mind, if it is holding subsidiary, we will eliminate. If it is an associate, will we eliminate? We will not eliminate, right? Then goodwill in respect of acquisition of S Limited has been fully impaired. So, whatever goodwill you calculate, you have to carry out 100% impairment. The recoverable amount of the investment in A Limited exceeded its carrying value as on 31st March. So, recoverable amount is greater than the carrying amount. Is there any impairment? There is no impairment. Okay. Now, NCI is valued at proportionate share of identifiable net asset. So, when there is goodwill impairment, if it is fair value, you have to attribute it to parent as well as NCI. If it is not at fair value, if it has proportionate share of net asset, then only the parent will bear the impairment of goodwill. 10% dividends were declared by both H Limited and S Limited, whereas A Limited declared 15% dividend for the year 23-24. Now, here this is an exam question. Now, there is lack of clarity as to when did they declare. See, when you say 23-24, if it is interim declared dividend, then you would have declared and paid. If it is a final dividend, it would have happened in the subsequent financial year, not in the same financial year. So, here we have to make some assumption, and even in the institute suggested answers, they have given 3 suggestions or 3 treatments, and you could choose any one of these. Now, normally when they say declared, what we could assume is actually they want us to make a provision for dividend and show it as a liability. That is what ideally would have happened, or you can say it is an interim dividend declared and paid. Okay. On 31st March of 24, S Limited made a bonus issue of 1 equity share for every 2 shares held by the shareholders of S Limited. 1:2. 1:2 ratio, 1 share for every 2 shares held. When did they make? On 31st of March of 24, they have made this bonus issue. Dividends were declared but were not accounted for by all these companies in the books before the year end. Similarly, the bonus issue was not reflected in the balance sheet as on 31st March. So, dividends were declared but were not accounted for. So, we have to account for that. The bonus issue was also not accounted. We have to account for that. You are required to take note of the above available information and draw the consolidated balance sheet of H Limited as at 31st March. Notes to accounts are not required. Of course, it is a 14 marks question. If they ask us to prepare even notes to account, it will be a very long question. Okay. Now, here some things that we have to understand: dividend treatment and bonus related treatment. Rest all are simple and straightforward. One more thing is to identify what is the pre-acquisition, post-acquisition. They have given us retained earnings on that date. So, no need to worry about that as all. No need to worry about that as well. So, with this understanding, let us look at the solution. How do we solve this particular question in a step-by-step manner? First thing, date of acquisition. See, you don't need to write this in the examination, but while practicing, you should be sure that yes, you have selected the dates correctly. Now, date of acquisition for S Limited, What is the date? They have said the date of acquisition is 31st of October of 23. Okay. And for A Limited, it's not actually an acquisition when it became an associate. Okay. That is on 30th of June of 23. Okay. Then controlling stake. Now, if you look at the question, they say 2 lakh shares and 1 lakh in terms of total value. Per share value is 10. So, here we have 20,000 and here we have 10,000 shares. Now, out of 20,000, this entity holds how much? 14,000. So, 14,000 out of 20,000 is how much? This becomes 70% stake, and 4,000 out of 1 lakh becomes 40% stake. So, what we will do? The stake, controlling stake in S Limited is 14,000 divided by 20,000, that comes to 70%, and non-controlling stake is 30%. Okay. Now, as far as associate is concerned, it is not a controlling stake. You can just say in associate investment, that is how much? 40% investment is 40%, right. Now, after having done this, what we will do? We will do analysis of reserves or identify how much is the pre-acquisition and post-acquisition reserve. Now, here, to be frank, it is not really difficult because they have given to us in the question directly that on the date of acquisition, the retained earnings is 5 lakhs and here the retained earnings is 1,75,000. Now, for associate, we just need to calculate the goodwill amount, but we do not need to actually incorporate or show that separately in the financial statement. As far as S is concerned, for S we need to calculate the goodwill. This all of us should be aware of. So then analysis of reserves of S Limited. Okay, so you have equity share capital. As per balance sheet or on on date of consolidation, how much will that be? And what is there on date of acquisition. Now, equity share capital on date of consolidation is how much? Equity share capital on date of consolidation is 2 lakhs plus bonus. 2 lakhs plus bonus. So, you will have 2 lakhs plus how much is the bonus? 1 for 2. So, that is 1 lakh. Okay, that is your equity share capital. Then, what is your retained earnings? Then what is the retained earnings? Retained earnings on date of consolidation, if we see, is given to be 7,50,000. Now the next step is identifying the net assets on the date of acquisition, which we typically do by analyzing the reserves. So analysis of reserves of S Limited. So you have equity share capital, then you have retained earnings, right? Now, one thing that you have to keep in mind when you are solving this question is there is a bonus issue. The bonus issue will impact retained earnings. Then you also have dividends, right? Now, as I was reading the question, as I told you that dividends, we don't know whether it has been declared, not declared, paid, not paid. So for the first answer or the first assumption which even the institute has taken, we'll assume that dividend has not yet been declared. It will be declared after the financial year end in the AGM. So there is no impact of dividend. So first solution we'll do, assuming dividend has not been declared yet, it will be declared in the next period. You write it carefully in the examination, and then in the next two adjustment, in the next two assumptions, we will see what is the impact if the dividend is paid, right? So now you have analysis of reserves, equity share capital. How much is equity share capital on date of consolidation? As per the balance sheet, what they have given, it is 2 lakhs. So 2 lakhs. And retained earnings on date of consolidation, as per the balance sheet, if we see, it is 7,50,000 other equity. Okay. Now, we have not yet given the impact of bonus. So what we should do? We should definitely give the impact of bonus. So you can add bonus shares. How much is the bonus shares? 2:1, so 1 lakh. Where will we get this bonus share from? We will get this bonus shares from retained earnings. We will get this bonus shares from retained earnings. So my retained earnings capitalized will be minus 1 lakh. So in other words, I can say this is 650, retained earnings is 650 and equity share capital is 3 lakhs. Can I say that? Yes, I can say that. I have given a breakup for your understanding. So ultimately if you see equity share capital 2 lakhs plus bonus shares 1 lakh 3 lakhs, 750 minus 1 650. The total if you see after this adjustment, the total is 9,50,000. And what is the total before adjustment? What is the total before adjustment? Before adjustment also it is 9,50,000, you can see it here. So, please understand that point that I am trying to tell you here is, even if I make the bonus issue related adjustment, it will not impact my total shareholders equity. I am simply moving from one bucket to another bucket. I hope that is clear. So, now on date of acquisition, equity share capital was 2 lakhs. Retained earnings, what they have given to us in the question on the date of acquisition is 5 lakhs. Date of acquisition is 5 lakhs, right? Then how much is post? Post acquisition is this 2 minus 2, if I do it is 0, there is nothing there. 2,50,000 is the post acquisition profit, 7,50,000 minus 50,000. Then this minus 1 plus 1, the impact will be 0. Minus 1 plus 1, the impact will be 0. Now, some of you are smarter. Sir, what if we write 3 lakhs here and 6,50,000 here and don't show this? Even then the post acquisition becomes 2,50,000. So, what I suggest is don't make it complicated. You do it in a simplified manner so that you don't have any problem in the examination. Okay. So, 2,50,000 is the post acquisition profit. On date of acquisition, the net assets is 7 lakhs. And post acquisition profit is 2,50,000. Okay. Now on this post acquisition profit, what is parents' share? Parents' share is 70%, 2,50,000 into 70%, 1,75,000. NCI share is 2,50,000 into 30%, NCI share comes to 75,000. Okay, simple. Then the next step is goodwill computation. Now for goodwill computation, what do we take? First we take what? Now, the fourth step is goodwill computation. So, here we will take what is the purchase consideration, fair value of purchase consideration. Now, where they have not said what is equity, what is this, what is that, they have directly given to us in the question investment value. So, what you will do, you will directly jump into the investment value, and here the investment value is 5,60,000. So, that is what we are concerned about. So, 5,60,000 is the fair value of purchase consideration. NCI on date of acquisition is how much? Using proportionate net assets method. So, NCI on date of acquisition will be 30% of 7 lakhs, that will be 2,10,000. Okay. So, total becomes 560 plus 210, 7,70,000 less identifiable net asset. What is the identifiable net asset? Identifiable net asset is what we have calculated here, 7 lakhs. So, you will say minus 7 lakhs, right. So, goodwill is 7,70,000 minus 7,70,000 minus 7 lakhs, we get 70,000. Now, this goodwill is fully impaired as per the question. So, you would say less impairment 70,000, carrying amount will be 0. Now, please remember, whenever you do a consolidation problem, every adjustment should have a second adjustment impact. For example, here I said impairment. Now, immediately you should think, where will this impairment have an impact on? This impairment will have an impact on the P&L. Whose P&L? Consolidated P&L or consolidated retained earnings under other equity. So, this will be written off against retained earnings. Why? Because we have written off goodwill, the second impact will be in the retained earnings. These things if you keep in mind, consolidation questions will not trouble you at all. Okay. So, that is about the carrying amount of goodwill, which is 0, and 70,000 entire amount will be impaired. Will NCI bear anything? Please keep this in mind. If it is in fair value method, then only NCI will bear. If it is proportionate net asset method, only parent will bear. Now, coming back to the question, if you look at the adjustments, what all have we done? So, this purchase has been done, we have already calculated. Then we have to now calculate for associate as well. So, let us do the working for associate. Number 5, investment in associate. Now, as far as associate is concerned, you will follow equity method of accounting. You will take the investment, you will add the share of profits less any dividends which have been received. Now, in the first assumption, we are saying that dividend has not yet been declared in the current financial year. It is actually declared in the next financial year, and subsequently we will take the other two assumptions as well. Then for investment in associate, we need to calculate what is the goodwill attributable. We will not show it separately, but we need to do the calculation. So, what is the cost of investment? Cost of investment, if we see, they have given to us to be 1 lakh. Right? What is the share in net assets? Now, share in net assets is 40% of equity share capital plus retained earnings on the date of acquisition. How much is equity share capital? Equity share capital, here you can see, is 1 lakh, and retained earnings on the date of acquisition is 1,75,000. So, basically of 2,75,000 we have 40%. So, 40% of 2,75,000, that is 2,75,000 into 40%, which works out to 1,10,000. Oh my god, share in net asset is higher than the cost of investment. So, is it a goodwill or a capital reserve? It is a capital reserve of 10,000, 1,10,000 minus 1 lakh, 10,000 is the capital reserve. So, we have calculated that the capital reserve is 10,000. Now, we have to see what is the carrying amount of investment in the A. Okay. Now, for this what do? We take cost of investment in A, and how much is the cost of investment in A? If we come back to the question, cost of investment in A is 1 lakh. So, 1 lakh is the cost of investment in A, 1 lakh. Okay. And because there is a capital reserve which indicates that net assets of A is higher, net assets of A is higher. How much is the capital reserve? 10,000. So, you have to add that, add capital reserve 10,000, right. Then what do we add? We add share in post acquisition profits. How much is this? 40% of. So, if you see, the reserves retained earnings is 424. So, here it is 424 closing balance. On date of acquisition, they have said it is 175. So, 424 minus 175, how much is this? 0, 0, 0, 14 minus 5 is 9, and 13 minus 7 is 6, 269,000. Okay. So, or you can say 40% of 424, 123 minus 175, 123, how much is that? 40% of 424, 123 minus 175, 123, 40%, that is 99,600. Okay. So, the total comes to 1 lakh plus 10,000 plus 99,600, which is 2,09,600. Now, what we will do? We will look at other adjustments. Inventory of A Limited. Who is A? A is our associate. As on 31st March, include inventory valued at 60,000. So, this is the purchase price which had been purchased from H Limited. So, the holding company has sold to the associate on 1st of January at cost plus 20%. Means what? Cost is 100, selling price is 120, profit is 20. So, selling price is 120. For 60,000, how much is the profit? Now, what do we do with this unrealized profit? Please understand, this carrying amount of investment in A, this represents net assets. Now, in the net assets of A, our inventory, holding companies or parent companies inventory is lying there at a higher value. Now, we know inventory we have to show at cost only. So, to the extent of unrealized profit, we have to eliminate. Where will we eliminate it from? We do not have inventory, we have only net assets. So, we will eliminate it from the net asset. Clear? So, less unrealized profit on inventory. How much is that? That is 60,000 is the total value. This represents 120 divided by 120 multiplied by, we need 20. So, 60,000 divided by 120 multiplied by 20 will give me unrealized profit, but this is 100%. We are concerned with only 40%, which is our share. So, multiplied by 40%. So, if you do that, 60,000 divided by 120 multiplied by 20 multiplied by 40%, we get 4,000. This is unrealized profit which has to be eliminated. So, what is the carrying amount now? carrying amount as on 31st of March would be 29600 minus 4000, that is 2,05,600. There is no impairment of goodwill or any other thing that is given in the question. Okay. Then trade payable of H Limited includes 25,000 payable to A Limited. This will not adjust because it is a holding to associate, not to subsidiary. Then goodwill in respect of acquisition of S Limited has been fully impaired. This we have taken care of. This, the recoverable amount of investment of in A Limited exceeds its carrying value. There is no need to adjust anything, which you have already discussed. 10% of dividend, we are assuming this declaration of 23-24 has happened after financial year end. In the subsequent variation, we will see what if it was declared before the year end. On 31st March, they made a bonus issue. That bonus issue related impact we have already seen, and we have also seen that if bonus issue is made out of pre-acquisition profit, there is no impact on your goodwill or capital reserve calculation. You are required to take note of above and draw the balance sheet. Okay. So now let us draw the balance sheet, but before we draw the balance sheet, we are left with one important working, that is carrying amount of NCI. This we could have actually done earlier also, and consolidated retained earnings. Okay. So for carrying amount of NCI on date of acquisition, you will take it from working note previously where we have done. NCI on date of acquisition is 2,10,000. Add share in post acquisition profits. Share in post acquisition profit we have already calculated here, 75,000. We are not considering dividend, so carrying amount will be 2,10,000 plus 75,000, 2,85,000. Then consolidated retained earnings. Now as far as consolidated retained earnings is concerned, we have to take parents retained earnings. How much is parents retained earnings? In the question if we see, parents retained earnings is given to be 14 lakhs. 14,12123. Okay. Then add post acquisition retained earning of S. That will come from the previous working note. Post acquisition is 175. Then wherever we have done impairment, unrealized, all of that we have to adjust. So goodwill, here we have impaired 70,000, that we will write off. Then goodwill impaired 70,000. Then when we come to investment in associate, we have capital reserve. This capital reserve is not my retained earnings. Capital reserve separately I will show it in other equity. Then here we have share in post acquisition profits in investment in A, 99,600. So that will come. Add share in post acquisition profits. This is for A. Add share in profits which comes from A Limited. So this is 99,600, right. Then there is unrealized profit on inventory which we have to reduce. So unrealized profit inventory, that is 4,000, which we will be reducing. So if you see, we have taken, so just to cross check, have we taken everything? We have taken the retained earnings of, so just to cross check, we have taken the retained earnings of parent, then it is 9 lakhs, the retained earnings is 9 lakhs, I think we have taken 14 lakhs. Yes, this has to be 9 lakhs. Okay. Then, okay, so retained earnings is 9 lakhs. Then we have taken post acquisition from subsidiary, share of post acquisition from associate, and we have taken the adjustment for inventory, goodwill has been impaired, trade payable there is no impact, remaining everything we have done. So we are good to prepare the consolidated balance sheet. So total here would be 11,06,000 as consolidated retained earnings. Now with this understanding, let us prepare the consolidated balance sheet of H Limited, incorporating the subsidiary and the associate. So what we will do, we will just look at the question and plot the numbers one by one. Property, plant and equipment. We have H Limited, we have S Limited, and we have consolidated number. or if you want, you can show the workings of HNS in the brackets as well. Okay, so property, plant and equipment, H limited 5,50,000, 5,50,000, S limited 480, consolidated number would be sum of 480 and 580, 10,30,000. Then financial assets. Now under financial assets, investment in A limited. You will not show investment in S limited because that gets eliminated. So you will only take the investment in A limited, the consolidated number from the working note, that is 2,05,600. 2,05,600. Here you can refer working note number 6. Then we have current assets. Inventory 485, 123 and 382, 500. The total is 867, 500. A lot of students tend to reduce the unrealized profit from this inventory. That should not be done because that inventory is now with associate. We don't have inventory in our books. We have net assets from the associate. So we reduce it from the net assets. Okay. Then coming to financial assets. Cash and cash equivalent 89,000, 98,000. So the sum of these two will be 187,000. Then trade receivables 395,000, 305,000. The total comes to 7 lakhs. Right. Then we have goodwill, but goodwill is impaired. So goodwill will not appear in the consolidated balance sheet. So if you do the total comes to 29,90,100. Okay. Now coming to the equity sides, equity and liabilities, shareholders equity, equity share capital. Now equity share capital will show only of the parent. So only of the parent equity share capital is 5 lakhs. They have not issued any bonus or anything like that, so no need to worry. Then retained earnings. Retained earnings you will take from working note number 7, the total amount that we have calculated 11,600,000. Then this is under other equity, so let us note that. Right, under other equity we also have capital reserve. So we have taken equity share capital of the parent, then we have other equity. Now here other equity will show retained earnings plus capital reserve coming from associate. Okay. So retained earnings, our working was how much? 11,600,000 plus capital reserve 10,000. Okay. Don't show capital reserve separately. It will be a part of your other equity, which is retained earnings plus capital reserve. You can show the working here 11,600,000 plus 10,000. 11,600,000 plus 10,000 actually. It is 11,10,600. Other equity is 11,10,600. Then what do we have? Non-controlling interest. We have already done the working note for non-controlling interest. The non-controlling interest is at 2,85,000. Okay. Then financial liabilities. Under financial liabilities, you have borrowings, term loan. For parent it is 4 lakhs. For subsidiary it is 1,50,000. So the total is 4 lakhs plus 1,50,000, 5,50,000. See, the balance sheet preparation is simply addition of the numbers. Okay. After the basic workings are correct, this you can practice on your own as well. Then we have trade payables 379 and 165,500. The total comes to 544,500. And if you do the total, that is 29,90,100. Okay. Things where we could have made mistakes, trade payable adjustment, then unrealized profit or loss of associate. Okay. Those are the only two critical areas, and the capital reserve which comes out of acquisition of associate, that we have to add it under other equity. Okay. If this is taken care, this question is simple and straightforward. No need to worry at all. Now, as per the suggested answers, they have also told that multiple assumptions possible. Here we have said dividend is not declared, not paid. The next is dividend has been declared in the current financial year but not paid. And the last assumption is dividend has been declared in the financial year and also paid. Now, second and third adjustment, there is not much of a variation. See, in one case when you say not paid, you will show it as a liability. If you say it is paid, you will reduce it from the cash. So that part is not a problem. So what we'll do is, now we'll assume that, I'll just make a copy of this. Now here we'll assume that dividend declared but not paid. Now in that case, how will the overall scenario or overall calculation change? That is what we are looking at. Now when we move to the second assumption, that dividend has been declared but it has not been paid, means it has been approved in the current year, which we can think it is an interim dividend, and it has been paid subsequently. Okay, that is what is the assumption. Now if that is the assumption, then what happens? H limited has to provide for dividend, S limited has to provide for dividend, and A limited also should provide for dividend, okay, because it is not paid. Now when we say provide for dividend, we will basically reduce the retained earnings, because we pay dividend out of retained earnings, and we will pay dividend and we will create a payable, we will show it as dividend payable. So far so good, no problem. Okay. Now one thing that you have to understand is, when S limited declares dividend, then S limited will reduce its retained earnings and make payment to its shareholders, but there is a group company, that is H limited and S limited, when there is this intra-group transaction, S limited paying dividend to H limited, that we will have to eliminate, we will not record that. Only the dividend that is paid to outsiders, in this case the non-controlling interest, only that dividend will be recorded. Meaning to say, whatever profit they made, 2,50,000 out of the overall post acquisition profit. Okay, again here assumption is that the dividend has been made out of post acquisition profit. Now whatever is the profit that is made, that is 2,50,000, from that 2,50,000 dividend has been paid. Paid to whom? Paid to the, now when subsidiary pays dividend to the parent, that is an intra-group transaction, we will eliminate, we will not consider as if dividend has been paid. We are only bothered about dividend that has been paid to the non-controlling interest. Dividend that has been paid to the non-controlling interest. Now how much is the dividend paid? Dividend is paid as per the question 10% of face value. Now this also we don't know whether it is before bonus or after bonus. We have assumed that it is before bonus. So the dividend amount that is paid to NCI will be 2 lakhs multiplied by 10% multiplied by 30%. 60,000 is dividend that is payable to NCI. Not NIC, NCI. Okay, 6,000 is the dividend that is payable to NCI. So out of this post acquisition split, 75,000 that we would have added to NCI, we will say out of this 6,000 is payable. It is my current liability. It is not a part of equity. Now I have to make a payment of dividend. Sir, will we show any dividend payable to parent? No, because income of parent and other side there is a reduction in retained earnings of the subsidiary, they will knock off against one another, right? So parent share will continue to be 175, whereas NCI will say 75,000 minus dividend that we are paying or payable. Now here I don't agree with the institute's way of showing that parent will actually record in the consolidated financial statement as dividend from the subsidiary as income. That should not be done. Okay, so one adjustment is here. Okay, so now coming to the carrying amount of NCI. So here what you will do, you will say less dividend payable 6,000. Sir, what if dividend is already paid? Then also the same treatment, we have to reduce it from this. Okay, indirectly if you see, if this entry was already accounted for, then there is no need to make this adjustment. So then if the entry was already accounted for, do we have to adjust the parent consolidation? Now one more thing you have to keep in mind is, if this entry of dividend was already passed, then you don't need to do any further adjustment. So do we need to adjust the parent consolidated retained earnings in that case? No, even that you don't need to do, because you will reduce from the parent, because the parent would have accounted for dividend in its retained earnings. You will reduce from the parent, you will add it to the subsidiary. It doesn't impact the overall calculation. So what I am trying to tell you here is, now visualize a situation where the dividend entries have already been passed. Then what adjustments do we need to do? See, for NCI you don't need to do any adjustment. Okay, so assuming that dividend declared and accounted and also accounted properly is 20,000. How much is parent? Parent is 14,000. How much is NCI? NCI is 6,000. Okay. So this anyways will pay to NCI, NCI balance will reduce, things will be taken care because the total retained earnings would have reduced. What about this 14,000? This 14,000 parent would have accounted in its P&L. Now technically speaking, you have to eliminate this from the P&L. You have to reduce this 14,000 from the parent's P&L. Then what we will do? We will add that 14,000 to subsidiaries retained earnings. So you are saying at parent I will do minus 14,000, in subsidiary I will do plus 14,000, the consolidated retained earnings will be the same. So if dividend paid has been accounted for, no need to worry about it, no need to do any further adjustment. Okay, so this is the one thing, one change that will happen, that the NCI will come down to 279. Second, this is subsidiary. Come to associate. Second, come to associate. Now associate also will declare dividend, right? Whenever there is a right to dividend which is established, H will say that I have to receive the dividend. There is a dividend receivable. So dividend receivable, and the next entry will be, you will reduce it from the investment. Like when you receive dividend, you will debit cash and reduce the investment. Here also, any dividend which is declared, you will adjust. So you will say less dividend receivable. How much dividend is receivable? So if you see the question, I think they have said 15%. 15%, right? So 15% dividend on 1 lakh. So that is 15,000. 15% of 1 lakh, of which we will get 40%. So it is 6,000. Dividend receivable from A, we have to reduce. So if you reduce this, my carrying amount will become 2,03,600. Now please remember, the corresponding impact is what? From A Limited, I have to receive dividend. So I will say dividend receivable. I will say dividend receivable. So what if already received? I will increase my cash balance. I will increase my cash balance. So here it will be, so it will be debit, dividend receivable, credit, investment in A. Okay, debit. But if you have already received, then you would say debit cash, and you will reduce the investment, right? Then coincidentally both the numbers are same. This is also done. Now this dividend adjustment we have done, this dividend adjustment we have done. Coming to consolidated retained earnings, here we have a dividend to be declared. So we will say less dividend declared, 10% on the share capital of 5 lakhs. So 50,000 minus 50,000. That becomes 10,50,600. So here it will be debit retained earnings, credit dividend payable. Now where will we adjust each of these in the balance sheet? See, investment in A Limited will be coming down to 2,03,600. Now when I am reducing this to 2,03,000, investment in A Limited will come down to 1,99,600. When I am reducing it to 1,99,600, there is a current asset which is financial asset receivable. How much? 6,000. Okay. Then, so accordingly we have to update the balance sheet also. Then NCI number also we have changed to 2,79,000. So NCI number would be changed to 2,79,000. This is another thing which will change, right? This is one number which will come up here. Then investment in A Limited, this also undergoes a change because the investment number has changed. Then other equity will be 11,600,000 minus 50,000. Why minus 50,000? The dividend that we are declaring. Sir, what about the dividend that you have received from S Limited? See, from what dividend we have received from S Limited, in the consolidated financial statement, we will not show it as an income. Okay, one side the retained earnings of subsidiary are going down, on the other side retained earning of parent will go up, net impact will be same. So we will not add that. Sir, what about dividend received from A Limited? See, dividend received from A Limited is reduction in investment. It is not a profit and loss item. I hope you are clear with that. Okay, so that will become 10,60,600. Then we have dividend payable for the parent, which is 50,000. Parent has to pay 50,000, and subsidiary also has to pay dividend to the non-controlling interest, which is 6,000. So the total comes to 56,000. If you include that in the total, it again comes back to 29,90,100. Here also 29,90,100. Okay. Now just a quick recap of the adjustments that we did for dividend. Dividend declared by parent. Dividend declared by parent. Dividend payable 50,000, reduced from retained earnings 50,000. Dividend payable by subsidiary, only NCI component reduced from the NCI and show that as payable. So 6,000 reduced from NCI, show 6,000 as payable. Dividend declared by associate, show it as a receivable, reduce it from the investment. Okay. Now sir, what if cash has already been paid? Very simple. If cash has already been paid, here you will not have dividend receivable, you will add it to cash and cash equivalent. And here you will not have dividend payable, you will reduce it from cash and cash equivalent. I hope the question is clear. It is pretty comprehensive and you must have a look at it before you go for the examination. Let's now have a look at a question from November 23 examination. A very good question in terms of adjustments that they have given. But a couple of things which is bad about this question is, one, institute has ignored some of the assumptions, or institute has not taken some valid assumptions. Second thing is, in an examination scenario, it is really difficult for a student, how much ever prepared he or she was, they would have made one or the other mistake. So when you are facing such a difficult or a complex question in the examination, the best thing to do is to do it towards the end, because it was a surprise and some of the information was not completely given. But still, what we will do is, based on what institute has considered the assumptions, we will solve the question. I will also tell you how different things could have been treated differently, and accordingly you can have a look at the solution. The extracts of the balance sheets of Hammer Limited and its subsidiary Sleek Limited as on 31st March 23 are given below. So you have Hammer Sleek, this is the parent entity, this is the subsidiary entity. Non-current assets, property, plant, PPE, intangible asset, investments, inventories, trade receivable, cash, nothing new. Equity share of 10 each, so you have 1 lakh here and you have 50,000, the number of shares. Then other equity, then you have borrowings, short-term borrowings, you have bank overdraft, trade payables. You have split of PPE, then they have given goodwill. Goodwill is already there in the balance sheet. This does not mean we will not calculate again. Okay. Then general reserve, retained earnings. Now this part is on the date of consolidation. Okay. When is the date of consolidation? 31st March of 23. Then you have 8% debentures of 1 lakh. Hammer Limited acquired 20,000 equity shares of Sleek Limited on 1st of April of 22. So this date is 1st of April of 22 when 20,000 shares were acquired. Now if you see the 20,000 shares, how much stake do we get? You have 50,000. So 20,000 out of 50,000 means how much? 40%. Now tell me, if you have 40% stake, do you get control? You don't get control. That means it is not a subsidiary on 1st of April. Then what happens? It becomes an associate. The moment it becomes an associate, which accounting do we follow? We follow equity method of accounting. Means from 1st of April till the date it becomes a subsidiary, we have to account for share of profits from associate using the equity method. Now this part has not been done by the institute in its solution, right? Then the cost is 2,40,000 and further acquired 17,500 equity shares on 1st of October of 2022 at a cost of 1,92,500. So 17,500 out of 50,000 means how much? 35%. 35%. So 35 plus 40, total stake is 75% as on 1st of October. So our date of acquisition for subsidiary purpose is 1st of October of 22, right? Then the 8% debentures of Sleek Limited includes debenture held by Hammer Limited of nominal value of rupees 35,000. So there is an intercompany balance. What will we do? We will eliminate them. So here you have debentures. 35,000 is held by whom? By Hammer Limited. These were acquired by Hammer Limited on 1st of January at a cost of 84,000. This investment what Hammer Limited has done, where will we show it? We will show it under investment. So come to investment. Under investments you have how much? 84,000 they said, right? 84,000. 84,000 is the debenture. Now this debenture is investment in my subsidiary. It is an intercompany balance. I have to eliminate. I have to remove it. I will remove 84,000 from here. But on the face value side here, it is only how much? It is only 35,000. So what happens to the balance? From asset I am reducing 84,000. From liabilities I am reducing only 35,000. The difference, the balance of 49,000 is a loss. So that loss I will charge it to the consolidated P&L. Then The retained earnings of Sleek Limited had a credit balance of 75,000 as on 1st of April of 22. On that date, the balance of general reserve was 50,000. So this is on 1st of April of 22. We acquired on 1st of October of 22. So we need to know how much profit have we earned in this period. How will we calculate that? This opening balance, you will compare that with the closing balance. The difference is earned throughout the year. Out of that, half of it will be pre-acquisition, half of it will be post-acquisition. Sleek Limited has paid dividend of 10% on its paid up equity share capital out of the balance of retained earnings as on 1st of April of 2022 for the financial year 21-22. So they have paid dividend. Dividend is paid from the balance outstanding as on 1st of April of 22. The entire dividend received by Hammer Limited was credited in its statement of P&L. Now, one thing we have to understand is when we follow Ind AS, whatever dividend you receive, that dividend you will credit to P&L only. There is no concept of reducing the dividend from investment. There is no concept of reducing dividend from investment that you would have learned as a part of accounting standards in your CA Inter. Okay. So here they have credited to the statement of P&L, no problem. So do we need to eliminate this because it is an intercompany transaction? See, even if you eliminate it for sake, even if you eliminate it, you will reduce from holding company, you will add it to the subsidiary retained earnings, total consolidated retained earnings will not change. Okay. As per the resolution dated 20th February, Sleek Limited had allotted bonus shares at 1 equity share for every 10 shares held out of its general reserve. So 1 out for 10. So subsidiary has given 1 out of 10, which means 5,000 into 10, 50,000 worth of bonus shares out of its general reserve. They have not used retained earnings. They have said we are using our general reserve. The accounting effect has not been given, so we have to give the accounting effect. Trade receivable of Hammer Limited includes bill receivable of rupees 2 lakh drawn upon Sleek Limited. Out of this, 50,000 have been discounted with the bank. So 2 lakhs is the bills receivable. Okay. So Hammer says 2 lakhs is the bills receivable, and subsidiary will say 2 lakhs of bill payable. It is saying 2 lakh of bill payable, but out of this 2 lakhs of bills receivable, 50,000 is with the bank and only 1,50,000 is with us, which means subsidiary has to pay the holding company only 1,50,000, balance 50,000 has to be paid to the bank. So what is the amount we will eliminate, or what is the amount we will adjust? We will adjust only 1,50,000, that is between the companies. The 50,000 which is payable to the bank is a liability to outsider, and that liability has to be shown in the financial statement. During the financial year 22-23, Hammer Limited purchased goods from Sleek Limited of 25,000 at a sales price of 30,000. 40% of these goods remain unsold on 31st March. Again, they have not told how they have purchased, whether it is evenly throughout the period or pre-acquisition, post-acquisition. So we will assume, because such kind of adjustments are generally post-acquisition only. So it is post-acquisition, profit 5,000, and out of this 40% goods still are in inventory. On 1st of October, machinery of Sleek Limited was overvalued by 20,000, for which necessary adjustments are to be made. Depreciation is charged at 10% per annum. This is my fair value adjustment. What will I do for my fair value adjustment? Here they have said it is overvalued, means I have to bring down the value. If I have to bring down the value, I will do minus 20,000, right, on the date of acquisition column, and this 10% depreciation, because the value has come down, in the subsequent period depreciation amount will be lesser by that amount. The parent company has adopted an accounting policy to measure NCI at fair value based on quoted market price, applying Ind AS 103. Assume the fair value per equity share of Sleek Limited at rupees 11 on the date when the control of Sleek Limited was acquired by Hammer Limited. So this 11 is what? This 11 is the fair value on what date? On date of acquisition. That is on the date on which the control was obtained. Now this is used for NCI. This fair value will also be used to revalue our existing stake, because initially we had 40%. Now that has to be revalued. For that we will use this 11. You are required to prepare a consolidated balance sheet as per Ind AS, and it's of Hammer and subsidiary Sleek as on 31st March of 2023. Okay. So a lot of adjustments are known adjustments. They are nothing new in terms of adjustment, but The problem happens especially in an examination situation. So now let's have a look at the solution. So first thing, just note down what is the date of consolidation and what is the controlling interest and non-controlling interest, just for reference. In examination, to save time, you can ignore that as well. So date of control or acquisition is when 1st of October of 2023, right? Then controlling interest. Controlling interest is how much? They have said 20,000 shares. Controlling interest is how much? 20,000 shares plus 17,500 shares divided by 50,000 shares. Please note, bonus impact has not yet been given, so this is without bonus calculation, okay? And we are calculating the controlling interest on the date of acquisition. Even if bonus is issued, the percentage does not change. So 37,500 divided by 50,000, we get 75%. Non-controlling interest is 25%. Now non-controlling interest, number of shares, is equal to 50,000 minus 37,500, that is 12,500. Sir, why do we need the number of shares? When we calculate the fair value of NCI, we will need this number, right? Now, the next step, the most crucial step in this particular question is analyzing the pre-acquisition and post-acquisition reserves. Now, one more thing, as I told you, we are not doing the accounting for associate because the institute has not taken that assumption. But after the solution, I will tell you, if we had accounted it for as an associate in the first 6 months, what all would have changed, okay, and how the final answer would have been different as compared to the given answer, right? So the next thing is to identify or to analyze the reserves. What is pre-acquisition, what is post-acquisition, all of that we have to do the adjustment. So analysis of reserves, or you can call it calculation of net assets, right? So now what all do we have? We have equity share capital. This is on 31st of March of 2023. Date of acquisition is 22, not 23. Okay, 31st March of 23. And what is the balance on 1st of April of 22? That is what is the number they have. And what is the balance on 1st of April of 22? That is the number they have given. And we will need to adjust, and with this reference we can calculate what is the adjustment from 1st of April to 1st of October, and then what is the balance as on 1st of October of 2022. Okay, you can do it as a separate working note as well, but if you do it as at a single place, it will save time, right? So when it comes to equity share capital as given in the question, is 5 lakhs, right? And this is 5 lakhs on date of 1st of April also, there is no adjustment. So on 1st of October also we will assume it is 5 lakhs. Then we have general reserve. General reserve on date of consolidation, that is closing balance, is 1,25,000, and bonus issue has not been accounted for. Accounting effect of bonus has not yet been given. Okay, 1,25,000, and on the date of acquisition, the reserve was 50,000. Reserves is 50,000, and on 1st of April reserve is 50,000, right? Now 1,25,000 is the closing balance, 50,000 is on the 1st of April of 22. Means what? How much did we earn in the full period? I am doing this analysis of net assets once again, it has not come out properly. Now when we are analyzing the reserves, what you have to ensure is we have acquired the entity or the subsidiary on 1st of October. So the information that is given is on 1st of April and on 31st of March. We have to calculate what are the reserves on 1st of October. So we have equity share capital. This number we have as on 31st of March of 23. We also have the number on 1st of April of 23, and we need to see, what is the movement for the year. Then we have to adjust this for 6 months. Okay, of course for share capital will not have, but for others we will have, then we will get to know what is the date of acquisition amount. Okay. So, equity share capital, what they have given to us in the question, equity share capital if you see is how much? It is 5 lakhs. So, it is 5 lakhs. We have not yet given bonus impact, 5 lakhs on 1st of April. So, for now we will not do any adjustment, okay, and we will have on date of acquisition as 5 lakhs. Then we have general reserve. Now, when it comes to general reserve, how much do we have? General reserve on the date of consolidation is 1,25,000. On 1st of April when it was acquired, they have told us that the general reserve is 50,000. So, how much profit did we earn or how much amount did we transfer to general reserve during the year? 1,25,000 minus 50,000, that is for the full year. How much is for 6 months? For 6 months it is 75,000 divided by 2, 37,500. So, on the date of acquisition, what will be my general reserve? On the date of acquisition, my general reserve will be 50,000, what is on 1st of April plus 37,500. My general reserve is 87,500. Now, one more thing that you have to understand is, out of this general reserve, we have made a bonus issue. And friends, for bonus issue accounting, the simplistic assumption to be taken is that it has been made out of pre-acquisition reserves. If it is made out of post-acquisition reserves, then there will be some other, unless the question says that it has been made out of post-acquisition reserve, we will consider that it is out of pre-acquisition reserve. So, then what is the adjustment? From general reserve, we have made a bonus issue, right? Now, when you make the bonus issue, you have not yet done the accounting entry, you have to reduce the balance of the general reserve. So, I will reduce 50,000 from the closing balance. That entire 50,000 I will adjust from the opening balance on 1st of April. Entire 50,000 I will adjust from opening balance of 1st of April. Then if I have reduced it from the balance of 1st of April, this will also be reducing my balance of the date of acquisition. So, minus 50,000 here. So, because of the bonus issue, general reserve balance on 31st March has come down by 50,000, which is actually from the entire opening balance. So, there is no opening balance. Then, whatever is the date of acquisition general reserve balance of 87,500, out of this, can I say I have taken 50,000 for bonus issue? See, if I have taken 50,000 from 1st of April, can I say I have taken 50,000 from the reserves as on date of acquisition? So, here also I will reduce it by 50,000. So, my general reserve balance will now be 37,500 after doing the adjustment, right? Now, this minus 50,000 whatever I have done, this 50,000 is used for what? This 50,000 is used for issuing bonus share. This 50,000 is used for issuing bonus share. So, my share capital will increase. So, my equity share capital I will say add bonus issue. Now, this bonus issue what they have said is done on 28th of February. So, as on 31st of March, my bonus issue will increase the share capital by 50,000. On 1st of April, there will be no impact because of this. On the date of acquisition also there will not be any impact because of. So, on the date of acquisition also there will not be any impact because of this. Now, if I have to see what is my post acquisition. Now, coming to analysis of reserves, please understand that they have given us information on 1st of April, they have given us information on 31st of March. We need to find out what is the balance as on 1st of October, that is the date of acquisition. So, coming to equity share capital, we have the number on 31st of March of 23. That number what they have given is 5 lakhs. On this 5 lakhs there is a bonus issue. The question has said bonus issue of 1:10 was made. So, if on equity share capital if I add bonus issue, that is 5 lakhs divided by 10, it is 50,000. So, closing equity share capital is 50,000, 5 lakhs plus 50,000, 5 lakh 50,000 as on 31st of March. Now, on 1st of April of 22, what is the share capital? 5 lakhs. Did we have bonus issue on 1st of April? We did not have. So, this number is 0. So, the balance will be 5 lakhs, right. Now, this is as far as the equity share capital is concerned. Then, we have general reserve. General reserve closing balance, if you look at the question, general reserve closing balance is 1,25,000. Now on this from this 1,25,000 we have made a bonus issue. But sir, we made a bonus issue from 1st of April balance. Of course we made a bonus issue from 1st of April balance, but if you made a bonus issue, if 1st of April balance is going down by 50,000, should not the closing balance go down by 50,000? Yes. So less bonus issue. How much is the bonus issue? 50,000. 1st of April we had some balance 50,000 as given in the question. The general reserve had a balance of 50,000. So from here also 50,000 is gone. So basically closing balance after bonus is how much? 1,25,000 minus 50,000, 75,000 and 0 on 1st of April. Then how much did we earn for 6 months? See, general reserve moved from 0 to 75,000 or 50 to 1,25,000. What is the adjustment for 6 months? Adjustment for 6 months is 75,000 closing balance minus opening balance divided by 2, that is 37,500. What is this adjustment for 6 months? Please understand, on 1st of April, please understand, 50,000 is the opening balance, 1,25,000 is the closing balance. Means we have earned 75,000 for the full year, or we have transferred 75,000 to the general reserve for the full year. Now that entire 75,000 is not pre-acquisition, nor the entire 75,000 is the post-acquisition. What you have to do is, out of the 75,000, what we earned in the first 6 months is pre-acquisition, what we earned in the next 6 months is post-acquisition. So if I have to add some number to the 1st of April balance to arrive at balance as on 1st of October, I have to add 6 months general reserve. So that is what is this particular adjustment. So what is the balance on 1st of October? On 1st of October of 23, it is opening balance as on 1st of April 0 plus 37,500, we get 37,500 on 1st of October. Closing balance is 75,000. So what is post acquisition? Post acquisition is 75,000 minus 37,500, 37,500 becomes post acquisition. This is pre acquisition, this is post acquisition general reserve, right? Then now, what is the impact of this bonus issue on the equity share capital? See, we have removed 50,000 from pre-acquisition profit. We have capitalized that. So, notionally, it means that we have moved it from pre-acquisition reserves to pre-acquisition share capital. So, here also we will increase it by 50,000. So, we have 5,50,000 on the date of acquisition or on the date of obtaining control, that is 1st of October of 22, we have 5,50,000 as the share capital balance, because we have moved it from general reserve to the share capital. In real life, if a bonus issue is made out of pre-acquisition profit, there is no impact on goodwill or capital reserve calculation on the date of acquisition. So then why did we do all of this split? We did all of this because we had to split for 6 months. Okay, that is why we have done this adjustment. Otherwise, for a bonus issue made out of pre-acquisition, even if you don't do any adjustment, there is no problem, right? So that is about general reserve. Then retained earnings. Retained earnings balance on 1st of April is given to be 75,000. Yeah, 75,000. Then closing balance as per the balance sheet of retained earnings is 2,50,000. Means what? 2,50,000 and 75,000. How much have we earned? We have earned retained earnings as on 31st March is 2,50,000, right? Now, can I say 2,50,000 minus 75 is the earning for the year? We cannot, because the question again says that there is a dividend declared, and the declared dividend, they have declared the dividend. The question says Sleek declared dividend of 10% on its paid up share capital out of the balance of retained earnings as on 1st of April for the financial year 21-22. Entire dividend was credited to the P&L. Now here, first we don't know whether they declared dividend after bonus or before bonus. So we will take the assumption it is before bonus, and it is out of the retained earnings balance as on 1st of April. Is the accounting effect given for it? Yes, accounting effect is already given for it. So this 75,000 what you see on 1st of April, the balance actually we have to bring it down by the dividend amount, that is 10%. So less dividends, how much? 50,000. So here it is 2,50,000, here it is 75,000 minus 50,000, 25,000. So opening balance actually, or as on 1st of April, is 25,000. So opening balance effectively after paying dividend is 25,000. We are not saying opening balance is 75,000. Opening balance minus dividend is 25,000. Closing balance is 2,50,000. So how much did we earn in the full year? 2,50,000 minus 25,000. We earned 2,25,000. Out of this 2,25,000, we can say half is for the first 6 months, half is for the subsequent period. So the balance as on 1st of October is opening balance of 25,000 plus 1,12,500, that is 1,37,500. And how much is post acquisition? 137,500 minus 25,000, 1,12,500. In case you are finding it slightly complicated, what you can think of it is retained earnings by balance brought down 75,000 to balance carried down, how much is that? 2,50,000. Okay. Now we paid dividends. When you pay dividend, what is the entry? You will debit the retained earnings and credit dividend payable. So actually it will come here to dividend payable 50,000. So this side it is 3 lakhs, this side it is 75,000, which means 2,25,000 is by profit earned during the period. Out of this 2,25,000, what we are saying, 1,12,500 is up to 1st of October and remaining 1,12,500 is from 1st of October till 31st of March. That is the adjustment, right? So that is how you can do by preparing a ledger. Same thing in case of bonus also. General reserve, if you see, the opening balance what they have given general reserve is 50,000. So by balance brought down 50,000. Then to balance carried down, how much is the balance carried down? 1,25,000 minus 50,000. Sir, but they have given only 1,25,000 in the balance sheet. See, we have not given this adjustment. So 1,25,000 minus 50, balance carried down is 75,000. To bonus issue, equity share capital 50,000. So 75 plus 50, 125 minus 50, 75,000. This is the amount that you have transferred from the P&L during the year. So by preparing a ledger like this also, you can arrive at the balance as on 1st of October. Okay. So that is just for your better understanding. But to keep it simple in the examination, what you can do? You can just take what is the closing balance, any adjustments to be done, and what is the pre-acquisition and post-acquisition. Now you may have one more doubt, sir. In general reserve, we reduced 50,000 from closing balance as well as opening balance. Why did not we do that for dividends? See, for dividends, it has already been accounted. Means this 2,50,000 is after accounting of dividend. This 50,000 we are adjusting to know how much of opening balance is left with us. How much of opening balance is left with us? That is only 25,000. Okay. So this 25,000 plus half of what is the profit earned during the year becomes my pre-acquisition and balance becomes my post-acquisition. So we are done with equity share capital, general reserve, retained earnings. Then on the date of acquisition, what are the other adjustments? Then what are the adjustment? See, this is the acquisition, this is the information acquisition, we will use it to calculate goodwill or capital reserve. These debentures will be cancelled out on the consolidation date. Retained earnings we have already analyzed. Dividend paid out of retained earnings, dividend was credited to P&L, that is a correct treatment, there is no problem at all. You may have a doubt, sir, we have to adjust this dividend. No, how can we take it to the consolidated P&L? How can we show it in the consolidated balance sheet? See, for dividend, again I am repeating, what happens is, from holding, you will say, okay, intercompany dividend minus, for example, 5,000. In the subsidiary retained earnings, you have to add this 5,000. So the matter is closed. The impact will be 0. Okay, so don't break your head. Then bonus issue, it is now in the balance sheet only. Trade receivables is again intercompany. Hammer Limited purchased goods from Sleek Limited of 25,000 at a sales price of 30,000. Who purchased? Hammer Limited. From whom? From Sleek. So basically, who sold? Sleek sold to Hammer. Subsidiary sold to Holding. Who made the profit? Subsidiary made the profit. What is the profit made? Profit made is 30,000 minus 25,000, 5,000 of profit. 40% of these are still unsold. So here we will make the adjustment for post acquisition, not on the date of acquisition, less unrealized profit. How much is that? That is only in the post acquisition column, 30,000 minus 25,000 multiplied by what is the percentage? 40%. 40% remains unsold, that is 2,000. So 2,000 is unrealized profit. 2,000 is unrealized profit that we have to reduce from post acquisition profit. Then on 1st of October, machinery of Sleek Limited was overvalued by 20,000. This is a date of acquisition adjustment. 20,000 for which necessary adjustments are to be made. So 20,000 overvalued means we have to bring down the net assets on date of acquisition, less overvaluation of plant and machinery, right? Plant and machinery, how much? 20,000. So on the date of acquisition column, minus 20,000. Then for this 20,000, depreciation is to be charged at 10% per annum. So if the machinery has increased in value, we will charge more depreciation. If the machinery has decreased in value, we will charge less depreciation, which means we will add savings in depreciation. How much is that? 20,000 into 10%, that is 2,000. Don't make that mistake. It is 20% per annum. So 2,000 by 2, 1,000. Now where will we add that? We will add it on the date of consolidation, that is 20,000 into 10% divided by 2, will make it 1,000. On date of post acquisition, this is 0. Here minus 20,000, and the overvaluation will continue to be adjusted on date of consolidation. So post acquisition impact is 0 here and plus 1,000 here. Okay. Now this 20,000 minus 1,000, 20,000 minus 1,000, net 19,000 will be, that net 19,000 will be the impact to be shown in the consolidated balance sheet. Okay. So with this, we will get to know what is the, are there any other adjustments? No other adjustments for identifiable net assets. So the total, this on date of consolidation doesn't make a difference. So the total net assets on date of acquisition, that is on 1st of October of 22, works out to 5,50,000 share capital, 37,500 reserves, 137,500 retained earnings, minus 20,000 of fair value adjustment, 7,05,000. 7,05,000 identifiable net assets. Okay, that is on the date of acquisition. Now out of this, what is parent share? 7,05,000, right? Then on date of consolidation, then how much is post acquisition? Post acquisition is 37,500 plus 1,12,500 minus 2,000 plus 1,000, 1,49,000. So how much is parent? Parent is 75%, NCI is 25%. So 1,49,000 into 75% goes to parent, and 1,49,000 into 25% goes to NCI, that is 37,250, right. So this is the analysis of reserves. Now coming to goodwill capital reserve computation. What is the fair value of consideration? Fair value of consideration, first one is fair value of existing stake. Now for fair value of existing stake, they have told us that the price is 11. For the price is 11. How many shares? 20,000 into 11. 2,20,000. 2,20,000. This is the value of existing stake. Now how much did we acquire it for? We acquired it for 2,40,000. We acquired it for 2,40,000 means there is a loss. So that loss you have to adjust. Okay, so there is a loss of 20,000 on fair value adjustment. Okay, then consideration transferred. Currently what they have paid? 1,92,500. So the total consideration becomes 2,20,000 plus 1,92,500, 4,12,500. Then fair value of NCI. NCI we have calculated how many shares? 12,500 shares. So the fair value of existing stake is 2,20,000. Consideration transferred is 1,92,500 as given in the question. Then what is the fair value of NCI? Fair value of NCI is, we have to see how many shares? 12,500 shares. So 12,500 shares multiplied by 11, we get 1,37,500. That is the NCI value. Okay. So the total works out to be 4,12,500 plus 137,500, 5,50,000. What is the fair value of identifiable net assets? What is the fair value of net assets? Fair value of net assets on the date of acquisition is given to be 7,05,000 what we have calculated. So assets are more, payment is less, it means capital reserve. So capital reserve is 7,05,000 minus 5,50,000, 1,55,000. After this is done, remaining all is just simply additions of various items and you will get to the answer. Then what is the balance in NCI? Opening balance 1,37,500, add share in post acquisition profits. How much is that? We have calculated here 37,250. So the closing balance is 137,500 plus 37,250, 1,74,750. Right. Then our other equity, consolidated other equity. Now as far as consolidated other equity is concerned, we will take parents 100%, parents or Hammer's general reserve from the balance sheet, two lakhs, then retained earnings 3,50,000, share in post acquisition profits 1,11,750, share in post acquisition profit 1,11,750. Then now coming to consolidated other equity, we have general reserve and we have retained earnings, right. So general reserve, from the question we can see general reserve is 2 lakhs, retained earnings is 3,50,000. Then share of post acquisition reserves from subsidiary of Sleek, that we have calculated here, that is 1,11,750, that is the post acquisition component. Then after this what we need to see, then we have some more adjustments to be done. What are those adjustments? The first adjustment is that there is an existing stake which we have revalued and there is a loss. So loss on fair value of existing stake, that is how much? 20,000, right? Because we had purchased for 2,40,000, currently the fair value is 2,20,000. So 20,000 is the loss that we need to adjust there. Then while reading the question, we had seen that there is an intercompany investment also in terms of debentures and there is a loss on account of that, right? So the point here, if you see nominal value of 35,000, cost of 84,000. So when we cancel this out, there actually will be a gain or a loss. So when we come to that adjustment, we will do it so that you don't forget. Okay. So after this, we can go ahead with preparation of balance sheet, consolidated balance sheet of Hammer Limited. Okay. So looking at the balance sheet, assets, non-current assets. Non-current assets, we have PPE 6 lakhs, 3,25,000, 6 lakhs is Hammer, Sleek is 3,25,000. If there are any adjustment, then consolidated. Six lakhs plus 3,25,000. 6 lakhs plus 3,25,000. Is there any adjustment? Yes, there was a revaluation of property, plant and equipment. So here if you come to this adjustment, 20,000 minus 1,000, 19,000 you have to reduce. So you will adjust it by 19,000. So the consolidated number is 6 lakh plus 3,25,000 minus 19,000, which is 9,06,000. Then intangible assets. Now when it comes to intangible assets, they have given us 1,25,000 and 75,000, that is pertaining to goodwill. We will show as it is 1,25,000 plus 75,000. There is no adjustment, so that comes to 2 lakhs. Sir, what about goodwill and consolidation? We did not get goodwill, we got capital reserve, so we will add that under other equity. Then investments. Now investments, you have 6,25,000 for Hammer and 1,25,000 for Sleek. Now what is the adjustment? See, there are multiple items to be adjusted. First is the cost of investment, that is 2,40,000 and 192,500. So 2,40,000, 123 minus 192,500. Then there is an investment in debenture, that also would have been shown here. So the investment in debenture at a cost of 84,000. 84,000 we have to make an adjustment here. So 516,500 is the total adjustment. So the net amount that will be shown is 2,33,500, that is 625 plus 125 minus 5,16,500, 233,500. Then after investments we have current assets. Under current assets we have inventories. Inventories is given to be 125 and 160, and there is an adjustment, unrealized profit. How much? We had calculated 2,000, so the number is 2,83,000. After inventories we have financial assets, trade receivables. Trade receivables is 325, 123, 2,90,000, 123, and there is an intercompany owing. Now under intercompany owing we discussed that we have to adjust only 1,50,000 because balance 50,000 is to the bank. So minus 150. So that brings down the total to 465,000, 4,65,000. Then cash and cash equivalent. Cash and cash equivalent is 150 plus 350, so the total is 5 lakhs. Okay. Then after current assets you can just do the total. The total of the balance sheet on the asset side comes to 25,87,500. Then coming to equities and liabilities. Now when it comes to equity and liabilities, first is equity share capital. We know we take only the holding company or the parent company, 10 lakhs. Then other equity. Now for other equity we will fill up the number at the end after we do certain more adjustments. Then non-current liabilities. Under that we have financial liabilities, borrowings. Now this borrowing, what is given in the question is 1 lakh. Here you can see 1 lakh for the subsidiary, 1 lakh for the subsidiary. Out of this, how much is held by the holding company? 35,000 nominal value is held by the holding company. So it is 0 here, 1 lakh here, minus 35,000. Minus 35,000. Sir, why minus 35,000? Because 35,000 is held by the holding company. So 1 lakh minus 35,000, we get 65,000. Now here, when we adjusted investments, we reduced how much? We had reduced 84,000. So there is a loss. So loss and cancellation of debentures. loss on cancellation of debentures. How much is that? 35,000 is the face value and 84,000 is the cost. So 49,000 is the loss on cancellation of debentures. Okay. Then after borrowings, non-current liabilities, we have current liabilities. We have financial liabilities under that, short-term borrowings. Under short-term borrowings, we have bank OD, which is 1 lakh. Here, 350,000. Here, no adjustment. So we get 1,50,000. And we have trade payables. Trade payable, we have 3 lakhs. Another 3 lakhs here. And there is an adjustment of 1,50,000. So the number is 3 lakhs plus 3 lakhs minus 1,50,000, that is 4,50,000. Okay. Now what are we left with? We are left with other equity. Now we are under other equity, we also have capital reserve. Capital reserve, what we had calculated, 1,55,000. So the total of other equity comes to 747,750. So you can plot 747,750. So the total. Then after other equity, we have NCI balance. How much is the NCI balance? NCI balance is 174,750. So you can do the total here. Total sum of all of this, we get 2587,500, 2587,500, right. Now this is pretty lengthy question, and for a 14 marks it will not be tested again, I guess, but still it is good to have a grip of these type of questions, and also be careful that institute can sometimes throw up bounces. You have to keep your calm and solve the question, right. Now here one adjustment, which again institute has not taken that assumption, and I don't want you to break your head on that, but still for a knowledge, from a knowledge point of view, from a knowledge perspective, what if we had accounted for those 6 months as associate? Then what would have happened is, the 6 months of post acquisition, we had 1,49,000 of post acquisition profit, right. Out of this 6 months, that is 1,49,000 divided by 2, 74,500, this multiplied by 40%, 29,800 would have been added to consolidated P&L, added to consolidated P&L and also to consolidated investments. So 29,800, what you would have done? You would have added here profits of associate. How much? 29,800, that is 40% of first 6 months. 40% of first 6 months. 40% of 6 months. Okay. Now, after this is done, my investment value would have gone up by 29,800. Investment value would have gone up by 29,800. So, while calculating the loss on existing stake, I would have said 2,40,000 plus 29,800 minus 2,20,000. So, it would have been 2,20,000, it would have been 49,800. So, I would have done minus 49,800. So, the number would still be back to 747,750. This number would not have changed. Okay, I think that is why institute has not done that particular accounting. Okay, so we will also not do that accounting. 747,450 is the number, 750 is the number, and that is how we will continue. Okay, a very good question. Do practice this question, and the way analysis of profits has been given in the analysis of profit has been given in the net asset, and the way the analysis of profit has been given in the suggested answer, it is slightly complicated. So, you can follow this simplified approach as well.